right, so motivation. So the typical, very central question in empirical asset pricing is why do different assets earn different expected return? So the conceptual answer to this question is quite straightforward, just different risk, right? Higher the risk, higher the expected return. But then the question is, what are those fundamental risks that people care about when they are thinking about what is the right price, what is the right expected return? So we have some theoretical guidance for this question. Very classical, Merton's ICAPM says, okay, what is risk? Risk are these state variables that supposedly that can forecast changes in future investment opportunity set. And pricing agents observe these state variables. And if the state variables are so important, they are going to adjust their consumption at the same time. Therefore, these state variables enters the consumption process and hence enters the pricing kernel. So if you have a risky asset that covaries with the state variable, it should have risk and it should have different expected return. Weaker. But this conceptual idea remains largely conceptual and abstract, really because we only have limited empirical success. Some people approach this problem they say, okay, where do I find state variable? I use proxies that are macro indicators, GDP, inflation, industrial production. I run a VAR, extract the shock components, and call those shocks state variables. The problem with this is, of course, the pricing performance is really not ideal, and also the interpretation is kind of limited to those macro indicators. Another strand of literature cites ICAPM only as a fishing license to do multivariate asset pricing. So multi-factor asset pricing. So this is the characteristic sorted portfolios, SMB, HML, momentum that we all know, right? So we also know that we have the factor zoo problem that we have here, unless you know some of the Wheels method or my IPCA. And also, really the problem here is that this approach is really detached from theory. We still doesn't know what are the fundamental risks. So we try to bridge this gap between theory and empirics using news, really news, literally news printed on the Wall Street Journal. And here I'm arguing that news is actually really close to the original idea of ICAPM state variables. So if you think about it, news should be new information, should be unexpected. It should write about things that has predictive information about future investment opportunity sets. And the news should be closely related to current consumption. If something is so important that you are going to change how much you consume tonight, probably that should be a frontline story that's printed on this day's Wall Street Journal. Right? So I guess for this audience, I'm almost like preaching to the choir to say that news is really important, textual data is really important. But the additional message I want to convey here is, if you think about it, news is really close to the central concept in this canonical asset pricing model, right? So we are kind of not just running a predictive regression, a predictive exercise to use text to predict the return, but we are kind of giving the model, the canonical model, a better chance, take the model seriously, and we say, okay, news is really close to this object that already exists in the model, and we are trying to find that object and by estimating that model using this news data. Right, so as I said here, this is a fabulous source of information to answer this central question in asset price. So what are really good about this approach? Of course, this idea is now closer to what the model is originally thinking about. So better data, supposedly there should be better inference. If you really find the true risk, we should be able to get a global mean variance efficient frontier. It should price all other anomaly portfolio with low alpha, so we can test our narrative-based factors, whether they have those quantitative properties. So we find, yes, indeed, there is a pretty good pricing performance with the news-based factors. What's remarkable about this result is our factors, narrative factors, uses a whole new kind of conditioning information, right? So new conditioning information now only comes from news, And we didn't look at those characteristic information at all. Those information, how the literature has been evolving on that for decades. We didn't look at that, but we can still price those anomaly portfolios that are constructed using those information. And our pricing performance is really comparable to the cutting edge Fama French 5-6 factors, which are, after all, constructed with those characteristic informations to begin with. So we didn't use that information, but I can price those things. So this is the quantitative advantages. And I think maybe a little bit fancier part is the qualitative part that really brings better interpretability, right? So we're essentially building a connection between quantitative risk factors, this kind of abstract concept, and we are bringing that closer to the real world events, to real world things that you can actually read. So the interpretation of those risk factors are much more diverse. All kinds of news are very concrete, directly readable. We can do text labeling. So this is really bringing this abstract concept closer to real world events. So essentially there is a translation, a link between quantitative risk and textual news narratives, right? So before I go into the full construction, here is probably one most granular level representation of our result. This is the most granular representation of the pricing kernel, the SDF, right? So in a nutshell, what is this? This is basically the pure bad news Wall Street Journal you could ever read. All the bad news here in this red words, and or all the good news, pure good news Wall Street Journal you could read. All good words, high those kind, record high, those kind of stuff. So this essentially this is like an impulse response on the pricing kernel, the mean variance efficient factor. If I read this word, I think there is a shock to the positive shock to the MVE. If I read these words, I think there is a negative impulse response to the MVE. So this is a representation of the pricing kernel. Of course, this is at the word level. Later, I will also show you at the article level or at the narrative level. So empirical method, I think, of course, people didn't use news text, but went through macro variables, not because they think that's really close to the theory, but because using news that comes with empirical hurdles. So I think most of our contribution is demonstrating that there is empirical way to solve this problem, to actually use this data to estimate this model. So the problem at hand is really just a large dimension reduction problem. Every day, Wall Street Journal, a lot of data, high dimension. I need to reduce that down to 3, 4, or 5 state variables risks, because we believe, after all, the factor space is parsimonious, should be low dimensional. And eventually, I need to reduce that down to just one number, the pricing kernel, which is like the holy grail if you can get that for asset pricing. So this is a large dimension reduction problem. How do we approach that? First of all, we use narratives. What are these narratives? Are basically a topic analysis of the Wall Street Journal texts. So this is done in a previous, mostly done in a previous paper by my co-authors, using LDA, latent dirichlet allocation, to do topic analysis. What it does is looks at all these words that are mentioned and find the groups of words that are commonly mentioned in one article. If a group words always appear together in an article level, they are grouped together in an unsupervised fashion. So, for example, the one topic quite useful later on is labeled as recession. It contains words like slow down, dive, decrease, those kind of words. They always appear together. Right, so those are the topics. We have 180 of them. Those are the 180 narratives. And then we look at every article, what are the distribution, what are the allocation of attention allocated to this 180 narratives. And then the articles within a day is aggregated to a daily level. So now I construct a news attention allocated to the 180 narratives. So every day I have 180 numbers, right? So you see there's already a dimension reduction here. Is this 180 daily time series will be my quantitative data. I have effectively converted textual data into time series data that is much easier for me to work with. Right. All right. So from this narrative attention levels, we need to still reduce. We still have ways to go to reduce that down to 3 state variables. So let me again just take one example recession as an example. For each stock, I can calculate the time series covariance between the stock's return and shocks to this attention to recession, right? So if I find a stock that always drops, the return always drops when recession is mentioned, that tells me, okay, this is really a kind of a pro-cyclical return. It tells me, okay, there's really probably a lot of risk in this stock. It tells me something about this stock's risk exposure, its beta, right? So now it says the covariance with innovations in narrative attention tells me something about the stock's beta. So number one, I need to calculate those covariances. And of course, that's just one example with recession. I have 180 narratives. I don't know which narrative really matters. This is the typical problem of textual analysis. Some of the things are just apparently not relevant. Some topics are like humor, arts, apparently not related to the capital market. So I need selection. So this part, the second step, we use an upgrade to the IPCA method that we mentioned before. We put sparsity into IPCA. So now it's a latent factor model that can select relevant narratives to figure out what are the betas, the risk exposures, and also at the same time estimate those systematic factors. So roughly speaking, that's the process. So far, I have estimated the factors and estimated the connection, the model connection between factors and the narratives. So the model is done. Once the estimation is done, the estimated model is supplied to quantitative asset pricing tests and also supplied to qualitative interpretation exercises. All right. So I used more than half the time on introduction. I will go a little bit faster from now. All right. Let me skip the model, I guess. So the model is really just a canonical asset pricing model with a latent factor model. The only restriction I have here is to say I have state variables, low dimensional, and it drives my 180 narrative attention levels. And this relationship is given by this matrix A. And in this matrix A encodes how does the narrative related to the factors. So it's a 180 by 3 factors. And importantly, we believe this matrix has a row sparse structures. Those are the rows that are not zero are the narratives that are going to matter, that matters for the latent factor structure. Many of the rows are going to be zeros. I want to have an estimation that is able to induce a lot of rows that are zero so that effectively I can filter out those narratives that are irrelevant. Right? So I'm going to have row-wise sparsity facilitates narrative selection. Right? So estimation process. Step one, the estimation process, you can think of that as some kind of an upgrade to the Farmer-Macbeth two-step procedure. Step one is really similar to the step one of Farmer-Macbeth. Just run time series regression, but here is covariances between every stock's return and the 180 attention innovation, right? At the daily frequency. So it's a trading window. So basically every month, every stock, I have 180 narrative covariances with respect to the other narratives. So this is at a stock month level. Think about it. This is just like our characteristics: size, book to market ratio, momentum. Those are also stock month information. Those things you can sort on size to get a good investment strategy. So my message here, if you come from a practitioner mindset, is that, okay, my 180 narrative covariances, you can also sort on those. And the trading strategies by sorting on those narrative covariances are already pretty good. And eventually, when we estimated factors, the factors indeed can be explained as a dynamically traded portfolio that trades on those narrative covariances. right? But we don't do just sorting on that. We use IPCA to use the narrative covariance information, right? So for step 2, I'm going to supply these covariances as instruments for betas for the stock's risk exposure. So beta is 3-dimensional, and use IPCA to estimate this link. The rationale is that this 180 narrative covariances contain useful information about the stock's risk exposure. And how do I elicit that information? IPCA framework. I'm going to have this gamma matrix, 180 by 3 matrix that tells me, okay, which C matters for its beta. Of course, gamma is very closely related to the A matrix I told you before. Gamma also has a row sparse structure. Those rows that are 0 corresponds to the narrative that doesn't matter. All right. So to estimate this is going to be upgraded IPCA called sparse IPCA. Right. So what it does is to search over this matrix gamma and also the latent factors to fit the model to minimize sum of squared error of the model. Right. So this part is the original IPCA's target. And we add a lasso regularization term. This term puts penalties on row-wise Euclidean norms of the gamma matrix. So it's going to induce the row-wise sparse structure in the estimated gamma. Regularization constant lambda here controls the strength of the regularization. Right? Higher lambda, more regularization. Right? So how does a change in lambda changes the model fit, right? On the left-hand side, lambda equals 0. That's the IPCA benchmark, no regularization. Good model fit. As lambda increases, model fit decreases. The number of selected narratives decreases. The gamma importance decreases. But there's one thing that's not monotonic. That is the in-sample mean variance efficient factors Sharpe ratio. And very strongly, if I have a little bit lambda here, the Sharpe ratio is going to increase. That increase here really tells me I'm recovering, kind of being closer and closer to the true factor space, because theoretically speaking, if you uncover the true factor space, you should have the highest Sharpe ratio, right? So we just use this economic condition to do model, to do this parameter tuning. We just choose the lambda that gives the highest in-sample Sharpe ratio here, so we can even avoid doing cross-validation and all those things. All right, so that's how we do the estimation. Now we can look at the risk interpretation results. So the estimation reviews this narrative to state variable relationship. Like I told you before, I'm going to do this impulse response between some textual, either a narrative, an article, or a word, and how does that respond on the risks. I can do this plot, a little bit hard to read here. These are how does this different narratives has an impact on different state variables. So how to visualize this? I draw a better picture to visualize this. So to tell you how to visualize something I need to tell you about the factor space. Factor space is just a space. If you rotate to another basis, to another factors, it's still the same space. So there's an unidentification issue here. So I need to be specific about which direction I'm talking about here. Otherwise, it's meaningless. So first, I'm going to focus on this particular direction. That's really the holy grail of asset pricing. I'm focusing on the mean variance efficient direction, right? So I'm going to orient the result here, right? So this is the picture I copied from Cochrane's textbook. As you can imagine, this is quite abstract. It's quite mathematics. I cannot really easy to think about where is the mean variance efficient frontier. But now here is my rendering of the factor space. I can find the directions within this space, right? So I know there are positive shocks to the mean variance efficient frontier and negative shocks to the mean variance frontier, right? So I find there are two narratives. If you read these narratives, that gives me a positive impulse response on MVE, record high, and optimism, right? And at the same time, there's a negative shock to the mean variance efficient frontier, recession, right? So if I now see a stock that has a positive correlation with these narratives, that tells me, okay, this really has a positive correlation with mean variance efficient frontier, MVE, that should have a high expected return, right? At the same time, I have the orthogonal direction to the MVE. On these directions, I find narratives that are like trading activities, problems, bear bull market, international exchange. These are generally talking about the capital market without a strong directionality. So these narratives constitute important systematic risk factors, but after all, they don't bear a lot of risk premium, right? So why is that? I can zoom in to look at what are the articles that has high concentration to those topics, right? The positive one, a negative one, recession, positive one, record high. And here I'm highlighting the word that has a high concentration to the narrative. This is how the machine reads this topic, read this text. The machine recognizes, okay, these are the words that gives me a high loading on recession, right? So the machine doesn't know about automobile, doesn't know about what is UK, what is United States, but they can read these words to figure out it's talking about recession, right? So my observations here are that, okay, so this news approach really uses news events these events are organized quantitative in nature. Many of them are pieces of quantitative information, but it covers a wide range of issues. Automobiles, Wall Street Journal bonus. If you think about it, if we want to use quantitative data sets to cover this, how many data sets I need to keep track of? And how do I keep track of the changing dynamics of all those different issues, right? So this approach using news is essentially relying on the news production process. The editor helps me choose what is the most relevant piece of information at the time. And I can use that. I can use that to locate what is relevant. And I'm relying on the choice of the language to figure out what's the quantitative information from that piece of information. The choice of language is just the frequency that the editor, the writer of this news, use these words, right? If they use those words, certain words more often, I can read a quantitative information from that. And this is really how this news-based, text-based approach is different from if, let's say, I construct a very large data set, right? These are the trading activity words. Here are just the titles in the paper. We also have excerpts of the whole paper here, right? And this is the word level word level representation of the MVE factor that I told you about. We can also do over the time. I can look at the large spikes in this risk factors and go to those days and find, okay, what is the article on that day that has an implied shock to these factors that most lines up with what I have observed, right? So this is an explanation using specific concrete news of all these spikes that we observed, right? Different things, kind of small, you can read that. So essentially, this method can be deployed in real time to have a real-time translation between text to quantitative risk, right? So all these are possible. So the third part, I don't really have a lot of time, is on the quantitative evaluations, right? In a nutshell, here we do very standard asset pricing quantitative tests. All are out of sample. We evaluate out of sample Sharpe ratio. We evaluate out of sample constructed factors pricing performance. They have small alpha, high Sharpe ratio compared to the state-of-the-art methods, FAMA range 5 plus momentum, 6 factors, all good pricing performances, right? So again, we are really attacking those factors that are constructed using characteristic information, but we did not rely on characteristic information at all. So that's remarkable about this result, right? And I really have 20 seconds. Let me conclude here. What we did is we used some kind of a new data source, developed a new method to demonstrate that you can use this to estimate a very canonical, very central problem in asset pricing. We constructed systematic risk factors using news narratives. The two good results we emphasize: number one, rich and concrete interpretability, and number two, quantitatively, it has good pricing capabilities. Right? The empirical method, one important message is this narrative covariances are important. Narrative covariances can help form portfolios. And we use a upgraded IPCA called sparse IPCA to do a latent factor model with characteristic selection, right? So after all, I think this is just one demonstration that we can use news to tackle a central question in finance. Think about other concepts that are like beliefs, expectation, what are common knowledge, information set. Those things can also be approached using news. All right. So I hope there's a broad avenue of economic discovery going down this route. Thank you. And I look forward to Diego's discussion.
I would like to thank the organizers for the invitation. It's so nice to actually be able to talk without a mask and having somebody in front of me who's not my wife or my kids. All right, so this paper is about this narrative asset pricing, which comes, I guess, this inspired narrative economics book by Schiller that came out a few years ago. Typical Schiller's stories of behavioral biases and so on. A little bit of data, but mostly anecdotal. This paper is trying to actually push the agenda on using text to understand asset pricing, in particular, understanding where systematic risk factors come from using this Wall Street Journal text. They have the full text from the Wall Street Journal from 84 to 2017, which is a priceless data set. Things that I love about discussing this paper, I actually tried something like this 10 years ago with some data that I'm going to show you in a minute, and I just wasn't smart enough to actually be able to get in the results. But I do have a pretty good sense of what the authors are doing and what is driving things. I actually have read one of the SEED papers before. You can think about this paper as merging this LDA paper, the structure of news, that was the old title, with the IPCA paper that Yinan and Brian Kelly have put together. And I actually knew that the LDA paper, I had actually had a meeting with Asaf Manela, who was one of the authors there. I had read it really carefully. So when they sent me the invitation for the conference, I said, yeah, of course I'm going to read it. And then I realized it was a different paper. And Brian Kelly's papers are not easy to read, for those of you who have tried to read them before. They take a couple of hours to get around them. So anyhow, very exciting. I'm going to go really quickly through the theory. The theory is pretty standard. There's going to be some state variables out there. Excess returns are going to be driven by the covariance of returns with those state variables. The news are going to be related to those state variables in a linear fashion. I want to highlight that at the end of the day, what we care about is doing a standard asset pricing test. We're going to be running everything at the monthly level, but we have news that come in every day, and we're going to try to take advantage of that in this paper. And that's actually an important property of this paper. And the returns is canonical, going to be driven by some factors. And the key of the paper is to try to use this innovation to news, what is printed in the Wall Street Journal, to understand this risk premia, how they covary with these excess returns. I'm going to think about these correlations, daily returns with news innovations as the way to get at systematic risk. Estimation is actually non-trivial. But I said that I couldn't do this 10 years ago. The profession has moved a lot since then, luckily. And essentially, they're just getting the covariances using rolling windows, but pretty standard. That piece of the model I could actually do myself. And then this sparse IPCA is what chooses the factors on the loadings. You have a couple of different lasso penalties there with the whole idea. I mean, it's essentially like a daily final Macbeth with some lasso penalties. So we're going to end up with a bunch of zeros in many of these factors. Remember, they start with 180, these different news that are being covered in the Wall Street Journal. And I'm skipping a lot of the technical details, but essentially you can infer using these news, these covariances, and then these inherent risks factors in the background. So let me talk a little bit about the LDA, which is this paper by Brian Kelly, Leland, Asaf, and Dan Cheng, which is a fantastic complementary paper. This LDA model, for those of you who are not familiar with it, what it's trying to get at is words that occur in the news, which is essentially what the topics that are being discussed in the Wall Street Journal. The fit that they do of LDAs to this Wall Street Journal is phenomenal. As a human, you can read these topics and you know exactly what we're talking about. They're talking about oil, about inflation, macroeconomic, what have you, recessions, for example. So they're taking these 180 topics straight from that paper. They're not doing anything on that front. And then they're going to be calling the unexpected use innovations. They're going to take okay, what is the weight on that topic on a given day? And I'm going to subtract a 5-day moving average. To be honest, I'm going to complain a little bit about this piece, which I didn't quite understand what is bringing to the table. But otherwise, I mean, these loadings these topics are fairly meaningful, actually. I'm going to make another important point here, which is the correlations that they're actually running is between the returns on the assets on a given day and the Wall Street Journal articles written on that day that get published the following day. Okay? Now, most of these articles are written after the market closes. And let's keep that in mind as we move through the discussion. It turns out that having 3 to 6 factors seems to work best. And at some level, the beauty or the curse of the paper is that there's not that many narratives that load. There's this recession narrative, there's a record narrative, then there's some stuff on trading activity and a few others, but those don't load that much. So it's essentially, I'm going to call it the R words, recession and records, that are really driving most of the results. And I'm going to play around with that idea in a minute. I thought this was the most interesting piece in terms of decomposing in time to interpret what these factors are. Again, you can rotate these factors in different ways, so it's a little bit harder to understand what it is. But you can see, the mean variance efficient portfolio, which ones load, recession and recession high are loading. There is the 3 interpretations of these 3 state variables. And you can see, again, recession record high load fairly strongly. Okay. There's other results in the paper. There is some time to interpret these things, but at the end of the day, when you think about recession and record, there's not that much to interpret, and there is a lot of talk along those dimensions in these articles. I know for a fact. They do these out-of-sample regressions, which I think is the best part of the paper, because they're not using any characteristics. They're just reading the journal and coming up with some risk factors, and they can basically match Fama French. Which is pretty impressive, given that they're not looking at value, momentum, or anything like that. They're just reading the journal. So that in itself, they don't do better, but they do equally well, which is quite amazing. And then they have a few other macro forecasting exercises. I'll be honest, I did read this on the paper really carefully, so I know the evidence there is actually stronger than the one in this paper. So I don't know if this was a little bit redundant in my mind. I didn't compare them, next to each other this week, but I remember the other paper does have a lot of macro forecasting exercises that seem very, very relevant. Okay, so kudos to the authors for a paper well done. It's provocative, it's tight, it has all the bells and whistles merging these 2 techniques, the sparse principal component analysis, and then these topics, this LDA model from the text. And in the spirit of scientific discourse, I'm going to give you my few cents, the things that I still don't quite understand. Interpretation is going to be the main one. That's kind of a cheap shot, but I think it's relevant. Then thinking about LDA as narratives, these models are fantastic, but they're completely unsupervised. You just feed it to the computer is telling you what the Wall Street Journal is saying. But I don't know, is that what we care about? Maybe we care about whether you're positive or negative, right? Is the journal being bullish or bearish on a given day? This sentiment, the direction, that may actually matter a little bit. Then I'm going to show you a few things on these R words that we were mentioning, and then I have a few minor comments that probably one will not get to. And the first one is interpretation. The paper is a very heavy emphasis on this ICAPM. Nothing wrong with that. It's one of our leading theories, right? What drives risk? Merton wrote in the 70s. We all embraced it and studied. There is nothing wrong there. But there's very indirect evidence. It's just covariance with news. There's no consumption anywhere. And consumption is definitely one of the things that drives ICAPM. We don't really know, I think when I was at Dartmouth, Ken France would always be discussing, is it risk versus behavioral stuff? And this was a critical question back then. I think it's still a critical question today because I don't know the answer. Maybe Zero knows the answer. And I do think that this paper may actually make a case for a behavioral angle, because I do think that news are catering to human nature and our behavioral angle, in particular, our behavioral demands. So I don't know to what extent using text may actually help us eventually get down this route. The authors may say, look, I don't care what it is, we're capturing some state variables. I guess my argument is that you shouldn't call them ICAPM, you should just call them state variables that could be anything. Okay? There's nothing wrong with stepping away from ICAPM. LDAs measure narratives. LDA says about telling you what words they're using, what topics they're discussing. Are they talking about the oil industry or talking about macroeconomic announcement? Very effective at getting these topics. But these narratives come with color. I would actually argue that saying we're falling out of the recession has very different meaning than saying the recession keeps getting worse. The two very different statements. The LDA is not really going to make a difference between them. It's just going to tell you they're talking about a recession. And I think this is by the way where I stopped 10 years ago. Now that I've done a lot more stuff on sentiment and stuff, I think that the obvious idea and what I should have done 10 years ago is try to do some interaction. I was doing something different. I wasn't trying to explain the cross-section of asset returns. But this interaction between the topics and the sentiment when they're talking about these topics, I think is a very natural extension that the authors can do almost off the shelf. And yes, I mean, it's going to go from, you just think about neutral, positive, or negative, you're going to multiply 180 times 3. But I mean, this IPCA is precisely designed for these large number of factors. I don't think that's really a reason not to implement it. Now, as I said, recession figures prominently, and it's actually not just in this paper that it figures prominently. Is in the LDA paper is the main topic. Okay, this idea of talking about recessions. Now, what drives a journalist to talk about recession or to say record? Well, let me just actually show you some evidence on this. We can think about what is the proportion of recession words on a given day in the Wall Street Journal as a function of what happened in the market, for example. This is actually a slightly different regression the authors are doing in the paper. In the paper, actually inverting it. They do regressions on content, where content is these LDA weights, which at some level is not very different than just counting out how many times you say recession or you say reading. The postman's render this project, I'm going to be using this database that I have from a paper that's really almost 10 years old. The advantage is that I have a very long time series, starting in 1905. The disadvantage is that I only have a handful of articles per day. I don't have the full cross-section with tag articles and so on that the authors have in this paper. So I'm going to skip the table, just highlight the fact that the T-stats here are huge. I'm only counting recession here, okay? And they don't say recession that often. The typical day, these 3 articles are not going to say the word recession or the word record. The T-stats are huge. You can see that the signs flip. It's a very non-linear relationship. I'm going to try to convince you that. I'll show you a graph in a second. This is for recession. For record, it's a little bit different, but again, a lot of predictability. Okay, you can really predict whether you're going to say record or not, just looking at what happened to the Dow Jones Industrial Average that day. This is where the graph looks for record. The market goes up, much more likely they say record. That's not too surprising. Now, this one is a little more surprising because if the market goes down, they say recession a lot more. But if the market goes up, there's also a chance that they would say recession more. Fairly highly nonlinear. Again, the T-stats are huge on both of these areas. I'm using only recession, but if I put things like a bloom or slump or things like this that were part of that topic, I am sure the same results would actually go through. So what do I make of this? What I make of this is that it's pretty nuanced, these R words that the journalists are using. Do we think that this is fundamental risk that they're describing? Or do we think that they're doing something else? I don't really know what these journalists are actually doing. Let me just highlight that these were market returns. Okay, this Dow Jones Industrial Average that I'm using for this, which is obviously one of the main factors in their paper. So I think we need to think a little bit more when we're capturing, when we're using these daily returns and news. And there's these contemporaneous relationships. And here is something that I struggle quite a bit, because returns happen during the day. They write the news in the afternoon. So I'm putting here a T plus because this is the timing. Media comes after the returns. And this media is very correlated with market returns. You can read my old papers, or you can just believe what I showed you a second ago. When I was in grad school, you never regress. You have to have some FT measurability, right? Is media, there's a function of return, no returns is a function of media. Now you can say that happens on the same day, but we're just trying to get a topic, that's totally fine, but it's a little bit dissonant. Now, it's not clear what the journalists are doing when doing this. Are they providing useful information? Then they claim they're doing that. To be honest, I think if you look at the evidence in economics, for example, Genko and Shapiro, some of them that I've done myself, there's this confirmation bias. they're just writing something that they want to read, so they're going to read again the next day. This is sort of my behavioral angle here, which I do think plays a huge role when thinking about media. Maybe yes, entertainment value, right? Make sure they say something funny so they come back tomorrow. And this matters to interpret some of these things, right? Because what the authors are finding is that you see higher risk for assets that could vary with news that talk about recession. That's interpretation of the paper right now. My read of this is a little more nuanced. It's like, is it high risk for assets that move on these special days when the market is really going up and down? I don't know, but this is very different conclusions they're going to reach, at least in terms of the economics of it, which I need to get my head around it. I'm going to make a small technical point here, which matters. This moving average adjustment was unexpected. If you look at the autocorrelation between most of these media measures at the daily level, it's virtually zero. It's not quite a stock return zero, but very close. For the recession variable that I mentioned a second ago, is 0.02 autocorrelation. For sentiment variables, 0.2. It's a little more persistent than returns, but not much. So you really don't need to do this moving average. In particular, imagine you get 2 recession days in a month. That should be 2 events, right? But the journal is talking about recessions. If you do this moving average, you're going to end up with 10 days where there's variation. There's 2 days that happen, and then the ones with the moving average. So I think you're introducing noise, essentially. This is why I was a little bit surprised about that. So I'm almost out of time. I will make just one more point, which is a concessional asset pricing paper where they have tagged Wall Street Journal, and they're not using any of that. They're just using the LDA output, which at the very least is surprising. Anybody, I would love to have this corpora, which is not cheap, apparently, mostly because you can actually see when these guys show up. And we know that it matters being on TV, being in the journal, some Fang and Perez papers, and so on and so forth. So let me just leave it at that. Very ambitious project. Strongly recommended to read it. I am sure there's going to be a lot more papers along this path. I think news will eventually help us. These narratives that we have in the journal, that we have on TV, will help us try to understand asset pricing more generally. And I would ask the authors to actually share some of their output. The LDA paper is online, and they have tons of details. They're actually a lot of fun. I think the authors may actually help us as well. Mostly because there's old people like me who may actually do some correlations with simpler things like counting our words. Might help us understand what drives their results. Thank you.